Ready? So let's see, how do we video this thing up? Press that. Soon you shall be able to see through the magic of television, internet vision, whatever you call it. Intervision. Why didn't they be? That's better than YouTube. Intervision. That's my new thing. Randy says take time for tea. All right, folks. Good night. Have a good day. I'm out of here. All right. Oh wow, what a great example of picking up from last week. I assume somebody can see this by now. Maybe, hopefully. Oh, I didn't do my intro thing. I gotta do that. Look how disorganized we get. One little thing gets thrown off and it all falls apart. You know, which is interesting. We should talk about that's interesting because that's a good point. That's what's wrong with the global supply chain on PPE equipment. It doesn't take much because same with toilet paper, right? Like one little thing goes wrong because there's always enough toilet paper. There's always toilet paper stacked up everywhere, blah, blah, blah. But if for some reason people suddenly decide they're going to panic and stockpile toilet paper, there is absolutely no way in the world to restock those shelves. There's just no way to gear up those factories. There's only a certain amount of paper because you need to cut down trees and you need to ship the trees, and there's only so much, you can't just rack that capacity up. You can't just cut down more trees and put more trees on more trains and have more mills running 24 hours a day. It's already doing exactly what it's supposed to do because there's a very predictable amount of toilet paper being used in the world by 8 billion people. And of course, it goes up or down or whatever. I'm sure it usually goes up, and they make more capacity. Nobody can see this still. None of you guys? Did I do something wrong? Okay, can anyone still hear me? That's a good question. Now I get no responses. Anyway, he says to nobody in particular. So it doesn't take much for the global supply chain to be completely disrupted. It just takes a little panic, and all of a sudden there's not enough toilet paper, and it takes some months to get it back on the shelves. Uh-oh, can't hear you anymore. That sucks. All right, damn it. Eric says visual good, but you can't hear me. Sound is good, Eric says. Greg can't hear me. I can see charts and have audio. All right, well, tough luck, Greg. All right, wait, can I say, wait, can I type that? I can type that, wait. Tough luck, Greg. Others seem fine. So I'm going to say that. And everybody else seems to be okay, right? Otherwise, I'll restart. If anybody else has a problem, I'll restart. I can see in here everybody but Greg. That's interesting. All right, maybe he's just, he's like my wife, he's just used to ignoring me. Okay, all right, we're gonna move on then, thanks. So where were we? Oh yeah, supply chain disruptions, right. So the global supply chain is very easy to disrupt, especially because it's so stretched out among so many countries and so many factories and stuff like that. And as you guys probably know, we've been sidelining the PPE game with protective equipment. We're working with 3M to supply masks to the needy people in the only two people who actually need it, hospitals and I forgot, hospitals, healthcare, and charities. So we only are, we're going to bulk sit. We're working with 3M bulk sales, and we're only supplying to people with actual needs because the other people, the people who are flipping and hoarding make me sick, and they're actually being cracked down on by the government. But by making sure that people who really need stuff get it, that's like a huge function we can perform. So we're doing that, and we're also working on the glove situation. Those gloves that everybody needs to like cut your food now and be in Whole Foods and all the people in all the supermarkets and all the clerks and people who like to have the gloves. And there's just, again, the problem is a massive, massive uptake. Now like 3-4 times more people are using those kind of gloves, and they're only like one-time use. If you ever watch a deli guy cut your meat, he puts on a glove, he cuts your meat, then he changes, if he changes the meat, he has to take another glove. You can't have the same glove touch the same meat, which is crazy because when we used to do it with our hands, that wasn't the rule. You didn't have to change your hands, but you have to change your gloves. Anyway, so Massive increase in uses of masks, obviously. Everybody running around wearing masks, everybody running around wearing gloves, causes incredible shortages in the global supply chain, and you can't fix it easily. And even worse, if you do fix it, you're basically heading for disaster, because 3M, for example, is now producing enough masks for every single person on Earth to wear a mask, basically all the time. If you, we don't do it in America, but if you wanted to, in theory, there are plenty of masks to go around for everybody. More expensive, albeit, because it's the production costs have increased and the raw materials have increased, but there are enough masks to stop people from dying, which is good. So they've produced more, but the problem is, and it was under a government mandate. Why do you have to have a government mandate, Mr. Republican? Well, you have to have a government mandate because 3M knows that what's going to happen is they are going to double their production of masks. The crisis will be over, and they will have a lot of factories that make masks that have absolutely no reason to be making them. When this thing goes back to normal and only doctors and nurses and considerate Asian people wear masks, then those factories that 3M has been building at lightning speed right now are going to be idle, and there's going to be absolutely no reason for their existence until the next pandemic. So there you go. That's why masks are expensive, but at least we fixed the supply issue. But the problem for 3M down the road is going to be a demand issue. It means thousands of people working there are going to get laid off. It means that plants are going to sit idle. It means they have to depreciate the stuff. Hopefully the government is helping them and taking care of them. And obviously I think they're going to do well. We invested in 3M. I think they're going to do very well. But it's a bit unfair when you think about what happens to them on the downside of this thing. But you could say, oh, those evil regulators, they forced them to make something, but you have to force them to make something because they wouldn't make it otherwise. 3M would say, well, sure, now you need masks, but what's going to happen later? So they would just let everybody buy really expensive masks from knockoff manufacturers or something like that. And gloves are the same kind of problem, except gloves is a much more, it's a much more distributed network of suppliers. Like in masks, 3M is like the big daddy, they're the New York Yankees of masks. They're not even New York Yankees, they're it. They're Coca-Cola, but there is no Pepsi, basically. It's like, yeah, that's a better example. 3M makes masks like Coca-Cola, except there's no Pepsi, and everybody else is in the Dr. Pepper or below size. So that they're the whole game effectively in masks. And it's hard to replace them, so you kind of have to take them over. In the glove business, the government did not take over the glove business. They should have taken over the glove business, because you have thousands and thousands of factories all around the world cranking out gloves. They've always cranked out gloves. Now they just do it 3 shifts a day, 7 days a week. So mostly they've just cranked up the supply chain. Now the problem here is that although they have risen to meet the demand, the same factories that used to only open Monday to Friday, 9 to 5, are now 24/7. The problem is, at a certain point, those machines are going to break. They haven't broken yet. They've got a life cycle. Most of you guys know that mechanical equipment has a life cycle, and if you exceed the life cycle, things are going to start falling apart, and then we don't have the parts to replace them, and so on and so forth. So while we have enough gloves now, we're very close to the point where things are going to start breaking, and we're not going to have enough gloves, and we're going to have a massive shortage of gloves. So that's why this whole reopening thing is such a dangerous game to play, because I understand that hospitals are filling up in Houston, hospitals are filling up in Pennsylvania. Florida's got ridiculous amounts of new cases of the virus, but so far not so much hospitalizations. I think in Florida we don't have a lot of hospitalizations because most people just die. A lot of these old people, they get in a nursing home, they get the virus and they're dead. There's no hospital required. They were already dying of something for the most part. A lot of I'm talking about the hospice-y kind of places, and they're already dying of something, so they get the COVID and they're dead. That's it, boom. So there's no saving those people or anything like that. So I think that might actually keep some people out of the hospital. Anywho. Supply chains, that's where we were. So the global supply chains are easily disrupted, and especially when you have a crisis like this, because the just-in-time manufacturing thing that hit us back in the 90s and into the 2000s, that was fantastic for the global economy. That's why we are now in the NASDAQ double where we were back in 2000. I mean, we've gone up 100% in the NASDAQ since the highs of 1999. So in 20 years. And that's not bad. If you 20 years, if you're, it's not obviously compounds, but 5% annual growth, 4% annual growth, whatever it is, it's really good annual growth. And you say, where does that come from? It comes from things like just-in-time manufacturing, that instead of having big giant warehouses full of parts that we would pull, we have enough computers and tracking systems and such that we count on there being enough parts for Mercedes based on the usual use of Mercedes. We know how many parts they're going to need over how many years and how much should be shipped on any given month and what months they have the most driving and therefore the most tires are needed and everything else. All this is done by computers now, and it's all done to the penny and to each unit. And the problem with that is, what if they're wrong? What if the models break down? Then everything blows up. And that's the kind of stuff that's happening in this crisis. And that's why some companies, you think they'd be doing good, but they're not, because something broke down in the supply chain. Some companies are doing great and you're surprised, and that's because for whatever reason they were on top of the supply chain, or maybe they lucked out. But there's all kinds of reasons. You have to think about that when we're looking at earnings very soon. We got a week until July 1st, probably 2 weeks until the first earnings reports comes out for Q2. And you got to watch that. There's a lot of moving parts to these reports, and we're going to have to be very careful about how we evaluate them. All right, so now it is time for questions. Let's see. Disclosure. Robin wants disclosure. All right, everyone can blame Robin for reminding. Thank you, Robin. Let's keep things legal. All right, so let's do that first. Oh, she's like that kid in the class. You like the kid in the class, and you raise your hand. Teacher, you forgot to take our homework. Anyway, so where are you? Oh, that's not the right place. There we go. All right, and at least it's fast, right? Let's see.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before taking any trades.
I can get my teeth.
All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. Hey, I beat that back by a mile. Wow, I thought that was going to be close. It wasn't even close. I managed to zoom in and out. Eric says, do I have an opinion on VTR? No, I do not, frankly. Where are we? Do we even have a thing to look that up? There we go. How are they looking? I honestly haven't looked at them in ages and ages. They're trading at 13 billion right now. Hang on, oh, you can't see me. I always forget that you can't see that. I move the comment screen around, but nobody knows what I'm doing. Like, why is he doing that with his mouse? All right, so 13 billion bucks is way too much. I can tell you that right off the bat. Well, they're making good profit, I gotta tell you. But let's see. See, that's that's trailing. I'm sorry, they're not making good profit. So once upon a time, they made a lot of money, but that's not really normal for them. Apparently, they make about not even 20%. Let's say they average maybe 10, 15% to the bottom line. Revenues are flat. There's not a lot of growth. Maybe they expect a bit more this year for whatever, you can have one-time gains and things like that, but it looks like the gist of it is they're really not incredibly profitable. So now you have to say, okay, let's say they're around $4 billion. Let's say their revenues come in around $4 billion, and let's say they make $4 to $6 billion here, $4 to $600 million here, and you're paying 13, so you're over 20 times the earnings, even if you're going to give them a couple of benefits of the doubt. So, I don't know a damn thing about how they're doing business-wise. I haven't looked at them at all. They haven't crossed my mind. It's probably, it's a good price considering they're usually trading at a ridiculous price, and now they're trading at a price that I would consider paying. But then the question is why? What's my compelling buying thing? And actually, why don't you tell me? Do you have a compelling reason that you think you should be buying them? And I'm not putting it down. I'm saying that it's right at where I buy something. But don't forget, I'm not a guy who's going to overpay for the NASDAQ just because everybody's paying 30%. 30 times earnings. I'm not into that. I'd rather just walk away and say, okay, well, I don't want to play that game. And frankly, by the way, I realize that makes me a good negotiator, because when I'm negotiating these big deals for masks and gloves and things like that, and I'm trying to do a transaction, I actually am very good at doing that negotiation. Why? Because I'm willing to walk away. It's the same thing. If it's not a good deal, I don't want to buy it. That's how you have to do these things. You can't go into something thinking I got to get this. If you see something, like I could read a great article about Apple and I can say, oh my God, Apple, they just had their conference and all this stuff is going on and so on and so forth. That doesn't mean it's the right time to buy them. And for God's sakes, how many times do we have to see the market collapse in our lifetime to think that we are never going to get an opportunity to buy something again? There's always an opportunity to buy something again, always. Never be in a hurry to buy something. If you don't get that, you'll get something else. There was a Seinfeld episode about that, actually. I think Gary's always like, if I lose something, something else comes along. If I break up with a girl, a better girl comes along. It's like, you can't be like fixated on something that you want. Just the other day we were talking about somebody we were talking in chat. I think it was Bernie, and we were talking about he had Apple and he was worried it was punching through, and we talked about a change, and my change was pretty conservative. So I'm saying take the 300-400 spread and keep it covered, because that way you'll burn this premium off quickly. You can sell it 10 more times along the way, and you'll get your money back, and you'll still have a 300-400 spread. And over time, I think Apple will get up to 400 in a couple of years. That's not a problem. But I think that it's probably ahead of itself right now. See this line? These guys are the right lines, especially the 200-day moving average. If you go back in history, this thing tells you effectively where it's going to go, and this will tell you the highs. And right now, we're a mile over where the high should be. And what happens when you're way over where the high should be? That's where you are. Okay, this tells you shouldn't be any lower than this, and you went below it and you were too low, and then you went a teeny bit too high, and now you're back up, and now it's acting more like Apple again, and you're going to be over your highs until the next correction when you go under the high and you come back to this line. That's probably going to be around 300 or so. So we give it 1, 2, 3, 4. So it looks like Christmas is going to be disappointing. That's or the buyer's resurgence. Apple already shut their stores down in Florida and California, I think, and Texas, and I think maybe Arizona. It was 4 states, four bad states that are having a bad resurgence in the virus. And that's an impact. Wait until Disney opens and they start showing the vectors of like really bad virus outbreaks coming out of Disney, and watch how fast they shut that thing back down. It's just I'm still dumbfounded that they're opening. We have 4,000 new cases a day in Florida now, and they're reopening Disney World. That's just perfect. So where are we? SK says banks have been under pressure. The Feds will announce the stress results. Oh, right. I don't think so. I think they're going to give them a pass. More than likely, they will do well. Is there a trade here? Options on Wells Fargo and BAC don't seem attractive. What about JP Morgan? You mean upsides? I don't know about that. Will the Fed admit that the banks are in trouble, or is there so much liquidity that nothing matters? Look, when push comes to shove, you bet on JP Morgan, you bet on Goldman Sachs. Okay. If we have the apocalypse and the and all the earth turns to ash and there's all lava rocks burning around, Goldman Sachs will make money selling lava rocks. They will. These guys, JP Morgan and Goldman Sachs, will make money in any environment. You just have to give them time to adapt. But their culture is such that they're full of people who look, they're smart people. A lot of them are bastards, but mostly they're just really, really smart people who understand finance and understand money. There's a lot of idiots work there too, but there's a core bunch of really smart people who frankly, I've met over the years. I have great respect for these guys. They are sharp. They ask the right questions. They sit in a room and you can give a presentation and they're going to be like, they're going to immediately understand your business and they immediately understand all the issues with your business and such. You got to respect these people. You don't have to like them, but you have to respect them. And these guys will find a way to turn things around and make money. For example, back to the PPE business, who finances the deals? JP Morgan and Goldman Sachs. There's money to be made there. They've got an asset. They're very happy to pick up these gloves as an asset and have them shipped all over the world. And they pick up a little bit of money, like 2%, 5% every week, 2%, 5% a week on shipping deals. That's what they do. Billions and billions of dollars every time, 2 to 5% they're picking up on shipping deals. So over the course of the year, what do they make? They make 100%, 50 weeks times 2% of billions and billions of dollars, just because they're financing shipping. And what does financing shipping mean? It means that they pay. Usually you would pay up front for the factory to start making gloves. So they pay 50% up front. Goldman Sachs will drop 50% of the factory. The factory starts making gloves. The gloves are owned by Goldman Sachs. Goldman Sachs puts them on a boat. They pay the shipper a couple of bucks to send it by sea or by air or whatever they're doing, or some combination, but they send the gloves by sea or by air. Now, the gloves on the ground, if you get them out of the factory, are maybe $7. By the time they get to the United States, they're a good $9. How much do they sell for in the United States? $12. But Goldman Sachs isn't selling them. They're only backing up the sale. So in other words, they'll extend credit to the people who want to buy them, but those people don't want to give an advance purchase to the factory. So Goldman Sachs and JP Morgan are doing that for us. So so you have Goldman Sachs and JP Morgan financing it, and they're basically, the only danger they have is, other than the ship sinking, of course, but the only danger they have is that the client for some reason bugs out and fails to do it, in which case they're going to collect a penalty from that client who put up the letter of intent or escrow or whatever. And if that client somehow declines to take the shipment or whatever, the big penalty for Goldman Sachs or JP Morgan is they have something that they bought for $9 and got it to America that can now be sold for $12 and could be sold for $11 in 30 seconds. There's basically no risk, and they're making money, and they put this whole operation together in about, I'd say, 10 days after this started to become a problem, the financing of gloves, because these gloves come in boxes and hospitals need 10 million boxes at a time, 1 billion gloves in 100 gloves in a box. They need 1 billion gloves, and they go through them in a couple of weeks. It's crazy how many gloves they use in hospitals. So they're spending a fortune on these gloves. It used to be like tissue paper. It used to be like $2 a box. Now it's $12 a box. It's really sad. And of course, what unfortunately is, though, Goldman Sachs and JP Morgan enable the speculation, because if it wasn't for them, if only real buyers could afford to finance the gloves, then it would go straight to the hospital and there wouldn't be so many middlemen. But because these guys step in and finance it, now it's got a bunch of middlemen who jump in the thing and jack up the prices. So again, brilliant guys, no morals whatsoever, not helping anybody, causing problems, making things expensive, but they get their fee. So you want to love them, go ahead and love them. Anyway, so JP Morgan, yes, I would go with JP Morgan. I would probably go light and then hope that something bad happens in the stress test and or other banks that don't do well drag down the sector, because they could easily go down 20%. I mean, it doesn't take much bad news to knock these guys down. But again, the liquidity is it's such a backstop. I feel pretty safe about it saving you. So we look at Goldman Sachs. Wow, also took a big hit. Well, I remember when I would never pay this. It used to be 180 like years ago, and I used to say I won't pay 180 for Goldman Sachs. But when they came down to 120, we jumped on them. So I like them when they're down. I don't like them so much. I'm not a huge fan up here. Certainly like JP Morgan better. And then I would look at Bank of America. Bank of America is not bad. They're not like, well, they're not evil as Wells Fargo, so you can play with them. And they're pretty low in the channel. I like that. Bank of America is almost like a butterfly we could do. See how steady they are? That's a perfect butterfly stock, right? It stays in its channel. So that's exactly the kind of thing we do look for in a butterfly play. And big oopsie here, but you know what? It gets right back to the channel, doesn't it? Because that's what it's worth. Stocks go back to where they're worth. If nothing really changes in their business model, and nothing changed in their business model, is people still bank, people still go to banks, they still need banks, they still withdraw money, they still borrow money. What changed? How does the virus change Bank of America? They're not Disney. People still need the money. You can stop going to Disney, you can't stop banking. And I just told my daughter that. Me and Madeline had a wonderful conversation. I really enjoyed it. She has $4,000 that she wants to invest, and she's opening up a Robinhood account. But she's not going to be gambling. She's going to be investing like a proper person. And we were discussing what should she be investing in, what does she want to do for the next 20 years. So I did what I did with you guys. I'm like, okay, it's time. Let's take out the compound rate calculator. Let's look at the difference between whether you get dividend stocks or whether you don't get dividend stocks. I'm obviously not having her play the options market or anything crazy. So I'm saying to her, just look, invest, and when you invest in these stocks like AT&T, like Viacom, like Pfizer is another one I talked about. Disney, I said, is also Disney for the long haul. I still like. We talked about stocks like that, and I said, look, you put your money in here, they're going to go up about 70% a year, just based on the normal stock market expectations. So put that into your compound rate calculator. So I said to her, here's what you're going to do. And I know I do this all the time, so tell me if it's boring, but I will say it until people start doing it, basically. That's my plan. So we take the compound rate calculator, and she starts off with $4,000, and she puts in, I told her, I said, put in another $1,000 every year. It's got to be your goal, is to put in another $1,000 every year. And I said, here's how you're going to be in 20 years. If you go with the standard stock market and it gets its normal 8% return, you're going to end up with $68,000. That's not bad. But I said, look at the difference, because if those 8% stocks pay if you get an average of 3% in dividends, you go up to 11% by picking dividend stocks, because you're getting the 8% that you're going to get from the growth of the market, and you're getting 3% from your dividends. And watch what happens. 68,000 turns into $103,000. 50% more money at the end of 20 years. And of course, when you move it to 40 years, because she's only 20, she is 20. So when we go to 20 years and talk about where she's going to be in 40 years, whoops, why won't you do that? Wait a minute, what happened? 20 years to grow, 11%, blah, blah, blah. That can't be right. Did we start out with 10 years? Oh, I'm sorry, 40 years. That was the point. I'm sorry, it's 40 point. $1 million. There you go. So it's in 40 is $1 million. Whereas if you just invest in regular stocks and follow the S&P, for example, 366,000. Look at that difference, right? 366 at 8, 905 at 11. So that really that worked. I mean, it worked for her. She's convinced. She's now a dividend kid. She's absolutely going to invest in things that pay dividends. And I told her that as she progresses, I'll start showing her how to do the option thing too. So we can take that 11% and turn it into like 15%, which is $3 million. Or if I can get her up to 20%, $14 million. Now, don't forget the nice thing about that is that the stocks adjust for inflation. So in other words, when you invest in a Pfizer or AT&T or whatever now, if the dollar's flat, and the dollar has been flat for many, many years, but if the dollar's flat, AT&T is going to stay at 30, Pfizer is going to stay at 30, whatever the heck it is, 33, I think. They're going to keep going at the same price, basically. But when you have inflation that affects everything, like a big inflationary boost, the stocks go up with the money, with the inflation, because you are trading your dollars for stocks. So stocks are a commodity that you purchase with dollars. So if the dollar becomes weak, the stocks keep going up and you make more money. So you will more or less, and they increase their dividends. Their earnings increase, not in real money, but in terms of they are now earning more inflated dollars for the same goods and services. And that way, more money comes in, more earnings drop to the bottom line. They're inflated, they're worth less, but so what? You are keeping up with inflation. So the dividends keep up with inflation, the stock price keeps up with inflation, and the options returns are going to keep up with inflation. So this is a way, way better way to put money away than anything else. And again, talking about a 20-year-old girl with a part-time job who has $4,000 and promises to save another $1,000 a year for 40 years. So when she's 60, she's going to have $14 million. And that's if she never puts in more than 1,000 a year. If she just keeps the original obviously 4,000. And if we can figure out, if I can teach her how to just run a basic little portfolio, sell some options, and get a 20% return. That's what's going to happen. And obviously, I'm going to make her do a lot better than that. So that'll be inflation adjusted money in 40 years that she'll have to retire on. So I convinced her. That works for her. Hopefully it works for you guys, because I think obviously that's what everybody's goal should be. And not just your goal, though, but you've got to teach your children well. As Crosby, Stills, and Nash say, you've got to pass this along. And it's got to start when you're young, because if you don't start when you're young, if you only have 30 years to save that money, even if you do everything right, it's $2 million instead of $14 million. The longer you wait, the more you cost. And I understand, obviously, if you're older, and most of the guys here are older, obviously, I hope you've already saved some money. But you just need to start off with a little bit more and work a little bit harder. But it's the same thing. I mean, even if you start off with $250,000 and you add, let's say, 10,000 a year, all right, and you do that for 15 years, and if you can manage to get 20% back on that, that's still $4.5 million, even if you only have 15 years to save it. And how do we do that? Basically, the butterfly strategy. This is what I'm teaching Madeline. I'm not teaching Madeline to sell naked puts. I'm not except when you're buying something. But I'm not teaching Madeline to short Tesla or anything like that or whatever. I'm teaching Madeline to take her money, put it into stocks that she thinks are valuable now and she feels has a future. I tell her that every time. Like I said, here we are. This is the best time you could ever imagine. By the way, that's what made my grandfather such a good investor. I realize that now. 100 years later, I see what made my grandfather a great investor. He was born in 1903. The Great Depression hit, maybe when he was like 26, 27 years old. He was in England at the time. Well, they got it too. So the markets crashed and things went to crap. And my grandfather, at that time, began putting money into stocks. He sold dresses door to door. He had very little money, but he took a percentage of his money that he made. He always took 10% at least out of every check that he got, out of every sale he made, and he put it right in the bank or right into his broker account. And that's what he did. And he would then buy the things that people needed. That's how he always put it to me. He said, buy things people need, not people want, people need. That's what I said to Madeline. I said, what are we doing here? I'm sitting in my house. What am I consuming? And you guys have probably seen these charts where all the rich people aren't spending and the economy's, it's bad for the economy and the poor people. But the poor people, in fact, I just did that Monday, Tuesday. It doesn't matter, forget the chart. Trust me, there's a chart. I just pointed that out on Monday, Tuesday. It wasn't the chart I used, it was a link to that chart that then if you looked at other charts, it showed you very clearly something. So there you go. But the point is that you're in your house. So it showed that rich people are spending far, far less money. Poor people are spending the same amount of money they spent before the crash. Why? I mean, within like 10%. And so you think, why? Well, because they didn't have any money in the first place. They spent everything they had on necessities. They're still spending everything they have on necessities. Whereas the top 25%, that was the bottom 25%, the top 25%, on the other hand, I can't go anywhere. I have to go way out of my way to spend a lot of money. I can't fly to Europe. I can't go stay at the Four Seasons in Las Vegas. And this is all pissing me off as I'm saying it. I can't go eat at freaking at the I can't remember, the Keen Steakhouse in New York. I can go to New York and stay in the goddamn hotel that I like and eat in the steakhouse that I like and go get sushi that I like. I can't do any of those things. And those things are expensive. I can't do them. I sit in my house and every once in a while I get myself a nice steak or something like that delivered. That is not boosting the economy. I have spending power, I just can't use it on anything. So that's why the rich are spending less. They can't go anywhere. They can't do anything. I don't want to get in an airplane. I'm not good enough to get in a private jet yet, so I can't get in an airplane. So I'm basically stuck. But there are, the private jet people, I'm sure, are doing fine. But then still, where do you go? Where do you really want to go? In fact, I had that conversation. I was just talking to a guy who's a billionaire, and he's talking about like which private islands he feels safe at. I'm like, dude, I think I'd feel pretty safe at any private island. He's like, no, you got to worry about the staff. They're thinking on a whole different level than we are. But anyway, so you see how that works. So obviously, right, the rich people can't spend the money they used to spend. You can't take the vacations. You can't go places. There's no point in buying cars and things when you're not even going anywhere. There's nothing to do. So I said to Madeline, I said, what do you use in a crisis? What are you, no matter how bad things are, what's happening? You're buying Kraft macaroni and cheese, and oh my God, how many times did I tell you guys that last year, right? What is it? KHC, right? KHC, right? Is that it? Yeah, KHC. Look what happened to these guys. Well, they came back nicely, but even last year, well, where is it? We gave up on them. I mean, I'll admit it. I kept telling you it was good, it was good, it was good, and then it was just people were so upset with that one. I just gave up. But last year they were down here, and I was like, I love them down here. I couldn't believe they were this cheap, and I said they're gonna come back. They're gonna come back. They came back, then they crashed, and now they came back again. But we're not in them. But I love these guys because again, obviously, what you look around your desk right now. Wherever you are, whatever you're doing, right? You are using a computer. You are using an iPad. You are using a phone. You are I'm holding my tea. I'm drinking something. I have my Fiji bottle of water. I have my my cold iced tea that I drink. I got my phone. I got my AT&T. I got my internet. I've got obviously I'm still doing my laundry. I'm still eating basic foods in the thing. And there's Kraft Heinz and all the other stuff that people eat. I'm obviously using all these delivery services. Amazon obviously is a big part of my life now, but that much more so than it was. These are the things you invest in because even when the world is practically ending, they're still going to make money. That's kind of obvious, right? If you're telling your child what to invest in the things that are real and make money and are now. I'm not saying invest in TikTok because, 5 years ago, TikTok didn't exist, and 5 years from now, TikTok probably won't exist. It's very rare that these guys have lasting power. Snapchat even is on the fade. Zoom is already fading out. You know, it's like these are trendy things. You got to be careful about trendy things. But I still need my computers. I still need my desk. I still sit in the chair. You know, there are certain things that are staples that are part of your life. I'm still wearing my clothes. I'm obviously not wearing dress clothes anymore, but my investment in the Gap is great, right? My GPS investment is good because people are still doing that. I'm not wearing out my sneakers like I used to, but we still wear sneakers. You got to invest in the basics that make life go, right? The things, the bills you're paying. And that's the thing. Look at your credit card statement right now. That's what you should be investing in. What are you buying even when everything is off? And that's the future. And I'm not talking about crazy growth future. I'm talking about safe, dependable, build your wealth 1% at a time every month kind of future. How are you going to do that? What's your plan for that? And that's what you got to be looking at. Is that tea? All right. That is a good one. I like that. All right. Bernie says, any company you think may be weak or strong coming into earnings? Wow. I mean, obviously, anybody who has to entertain people in groups, like any movie company, anybody who's look, all the hotels, all the parks, all the movie theaters, most of the restaurants, except for the ones that you have to think about that, who delivers the most? And by the way, he asked me, see, when you ask me a question like that, if I have time, if it's a weekend or something like that, I'm going to say something to Google. I'm going to say how. All right. Top fast food during crisis. All right, so here's QSR magazine, which is I forgot what the QSR stands for, actually. I should know that. Anyway, so it's a restaurant magazine. It's how you know all the restaurant business. Working in fast food, drive-through the lifeline, fast food chains open during the coronavirus. But the question I want to know is like, so I would read a whole bunch of those. I wouldn't read just one, but I would try to find what I'm looking for is who do I think is doing really well in this crisis? And so you say, McDonald's and Wendy's see upwards of 70% of their business via drive-through. So when you read about McDonald's and Chick-fil-A closing dining rooms, it's not that big of a deal to them. They don't care. But on the other hand, if people aren't even going out and driving, I think it's a big deal. I don't think that's a little misleading, possibly. Starbucks shut down, so they're not going to be the one of the great ones. And Starbucks obviously is going to take a huge hit in the second quarter because they weren't even open. I couldn't believe they closed Starbucks. I mean, I understand they're being safe for their people, but I mean, that is crazy because, oh my God, what a nice break from being shut in and all that. It's so nice to just walk over to Starbucks and get a cup of coffee and take a little walk. I think they would have done fantastic. Chick-fil-A, 14.8% year-over-year February growth. Well, we don't know what that ended up being. Visits were 30.7 since about February. McDonald's, Burger King. Okay, see, you know, you can get all these statistics if you want them. They're in there somewhere. And I'm not sure what quarter that's for. Where is this stuff? I don't know what date this is. You know, they don't date articles anymore. It's so annoying. They go out of their way not to date articles because they think that'll help people read it more often. But I'm like, oh, but then I start reading out of date articles. I get so angry. I don't know. It doesn't give me a good experience with these people. There you go. Late February to early March. This is a great chart. So what is this? Last week of February, week of March. Can we even figure out what this means? Last week of February to first week of March. Oh. No, I still don't understand it. What are you saying? Okay, all right, I get it. So here's the beginning of March of each year. There you go. Why don't you just say March? Really? All they had to do was write March 2019, March 2020, and March 2018, or write March 7th. I mean, holy crap. Oh no, well actually, wait, let's see. So last week of February wait. All right, so I guess you could write 2-1 to 3-1, something better than that. That's terrible. Anyway, bottom line is look at what's happening. Starbucks was actually, like I said, Starbucks comfort thing. I could see them doing great if they would have kept going in the crisis. That would have been smart. Who else picked up? Chick-fil-A. People like Chick-fil-A, makes them feel good. McDonald's, obviously, it's every once in a while. Isn't that their whole? Aren't they the ones to say you deserve a break today, right? And then you got Burger King, which is surprisingly strong. What don't people want? Why don't people want Friday? Oh, Fridays, because sit down. There you go. Perkins, too much sit down. There you go. It's so obvious, right? You got to eat food. What kind of food are you going to eat? You're not going to eat Perkins. You're not going to eat Fridays. You're probably not going to call them for takeout. When have you ever called Perkins or Fridays for takeout? It just isn't a thing that registers in your mind. But you will call to get your Burger King or your Chick-fil-A or your McDonald's or your Chipotle. Those are all good things. In fact, Chipotle, I know, had fantastic things, but also overboard. It's all it is. It's just being logical and following through and thinking about how the current situation affects what's going on in the world at any given moment. And then who says, SK says, you seem to like JPM or BAC. How do you construct a trade? It's feeling a visual, right? How do you construct a trade? Well, let's see. All right, first of all, we have to look at the chart on the long-term chart. And this is your fault if you didn't ask a question, because this is where we're going now. All right. So we're gonna do some basic stuff. JP Morgan. You have only yourself to blame if you didn't jump in and ask your own question. All right. Now, okay, I guess I don't need to see your question because I can keep that in my head at the same time. Now, how do I construct a trade with JP Morgan? Well, I hope JP Morgan goes lower so I can buy more of it. So I'm going to start off with a light position, and I'm going to put my put low because I fear I'm going to be assigned if there's another bad spike down. I think they will recover over the long term, but I don't necessarily want to have an underwater put. It's kind of annoying, so I'm going to try to pick something logical. My target for JP Morgan comes from here. I'm going to now go over here. I already know it, but I'm going to tell you and I'll show you what we do. So I'm going to go to JP Morgan and I'm going to think about their business. I'm not going to just look at the chart. That doesn't tell me much, but I'm going to look at the chart and think about their business. Say, whoa, usually very consistent, 95, 93, 96, 100, 109, 115, 114, even in a crisis, 110, 113. So not much growth, but steady. Normally they make 24, 25, 30. So normally they're going to drop about 30% to the bottom line, except not this year. And then this is pretty pessimistic for the recovery next year. I think that's probably too pessimistic, but even so, 25 billion is what we have to work with. As I said, these guys will make money. They will sell. They will make money after the apocalypse, selling you post-apocalyptic stuff. They will figure out how to make money on these trades. There is no way they aren't going to make money no matter what happens. And that's, I mean, you're talking about a huge amount of money. But anyway, so obviously we're going to say they're going to make $25 billion. You can buy the whole company for $298 billion, which is only 14 times earnings and 14 times these earnings. So, you got to give people a pass for this year. This year's a pass. Okay, so what? They had a bad year. I don't care. I'm not buying them for this year. I'm buying them for life. So forget this year. They're going to get back on this 25-30 track, and they're clearly worth the money. And they clearly are going to make money no matter what happens in the world. So I want to own them long term. And if they get cheaper, I'm going to want to buy more. There you go. So there's my premise. I've checked my premise. I've checked where they are. I've looked at what's going on with these guys. And now we look for a trade that's going to fit. Oh, look at TQQ. Oh, speaking of fit, right? Look at TQQ that we showed, right? Boy, do they slam down. Doesn't take much. Anyway, who were we looking at? Not you. Oh, I forgot about my S&Ps. No. Oh my God, I can't wait to forget about those. Ooh, wow. No shit. Okay. Oh, this is so painful. All right, fair. All right, I'm gonna leave that for now, just in case it goes lower. It'd be fun. So what are we talking about? Oh yeah, not TQQ. JP Morgan. So on JP Morgan, we got, if you remember from the chart, rather than going back to it, basically they bottomed out around 80. So I can sell the $80 puts for 10 bucks, and that's a free trade. Am I really worried about them going below 80? No, I'm not. I'm happy to double down if they go below 80. So, and again, keep it in proportion. What are you really committing to? So I'm going to commit. What am I willing to commit to JP Morgan? It's a $90 stock, and I don't mind it being 10% of my portfolio. So if I have a if I have a $500,000 portfolio, I'm willing to have $50,000 of JP Morgan, no problem. I have $1 million of buying power. Wouldn't think twice about having 50,000 worth of JP Morgan. How much is 50,000? It's going to be 500 shares. So I don't mind owning 500 shares at all of JP Morgan. So therefore, I'm happy to sell 5 puts. Not a problem. There's nothing bad is going to happen to me if I own 500 shares of JP Morgan. Is that the right number? 500 times 100, 500, 5,000, 50,000, right? So the play would be that you're going to sell the 80 puts. So I'm like, do I really want to sell the 80 puts? No, you know why? Because I'm only going to get 11 bucks for those, right? But I can get 1550, 1570 for the 90 puts. And it's not a lot more money. It's 470 more. It's not a little. So I'm getting about almost $5 more for $10 in position. And honestly, I'm still net $75 or less if it goes down, which is still lower than I think my target's going to be. So why should I sell the 80s and not collect the extra $4? No, there's no point. I don't care. I don't feel that weak about JP Morgan. Now, if I have to go up to the hundreds, they're below 100, so that makes no sense. But the 90s, I don't think they're going to go much below 80. You know, I don't want to be in the money. I'm not super gung-ho bullish on JP Morgan, but I sure as heck think they're going to hold 80. And if I think they're going to hold 80, then I may as well sell the 90s for 15. Why should I only sell the 80s? I can be aggressive also because I'm only going to sell 5 and I could easily go to 10. It wouldn't bother me. So I could roll to the 2023s and they're going to be the 80s anyway. And how do I know that? Because when you look at look at what's at the money now. So if the 90s are at the money now, 15 was the same one, 90. If the 90s are at the money now, 15. What if they were the 2021s? So what if they were these instead? Who's 15? See the 100s, and they're $10 higher. So I know that I will have in a year, I'll be able to roll these guys down for about $10 with no penalty. So I already know what's going to happen. I already know that as it gets closer to expiration, I'm going to be able to make a roll in 12 months that pushes to the 2023 80s. And then 12 months from then, I can go to the 2024 70s. So even if JP Morgan goes down, as long as it doesn't go down catastrophically, I'm going to eventually roll myself out of trouble. I feel very, very good about that play. And I didn't even double down. If I double down, I could look at what is $7, right? I would double down to the 750 one here. That's the 70s. So I could roll 2 times the $70 puts. I still would have collected the 15 if it's an even roll, which means I have 750 less than 17, which is 62.50. So now my question is, with JP Morgan at $94, am I worried about being assigned 1,000 shares at 62.50? No, that's barely more than the 50,000 I was willing to own anyway, except now I'm going to get 1,000 shares. So there is virtually no risk to me in selling the I'm sorry, there's virtually not I don't want to say no risk. What's the word? I don't care. I'm not worried about selling those for 15, because in my mind, all I'm doing is buying 1,000 for net 62.50. That's what that commitment is. The commitment is not for me to buy 500 for $15. I mean, sorry, for $75. I'm really committing to buying 1,000. I'm certainly going to roll, and I'm certainly going to do a 2x double down before I take a hit on this thing. And by that time, I'll be down to 62.50 or less on a stock that's currently 95 bucks. That's freaking JP Morgan. All right, so that's how I evaluate where my short put position is going to be. Now, what do I do about the longs? Okay, well, now we go back to the chart, because we already decided it's certainly worth the money. It's not even 15 times earnings for these guys, 14, I think we said, right? So now we go back to the chart, and we said, well, if it's 14 times earnings, it probably should be around, it's a bank, so let's say 16, 17 times earnings, but 16 or 17 times earnings is going to be a good 10% higher than it is now. So 105 is about right, and 114 is the 50-day moving average, but it goes as low as 105. I'm sorry, it's a 200-day moving average. That's weeks. That's the 50-day. So 105 is pretty much going to be the 200-day moving average, and that's what everybody thinks it's worth. Everybody thinks it's worth what I think it's worth. Okay, so that's the real price for JP Morgan. And I feel very confident in that. That makes sense to me. I don't perceive any particular threat to their business model. I think there's so much money sloshing around that they are going to do much better than projected. So I'm bullish. So therefore now I'm bullish from here absolutely to 105. And in 2 years, 110, of course 110. All right. So therefore now I know my target range. So now I go back to these things. And now I say, okay, the 110s are 10 bucks. That's a little high, but let's see where we are. So if I do the 110 for 10 bucks, what can I get for 20? I can get the 85s for 20. And if I do the 85 110 spread, that's going to be $5. No, I'm sorry, $10. It's going to be $10 on a $25 spread. Well, that seems reasonable. I don't mind that. So now I say, okay, what happens if I lower that? What if I go for the 100 calls? Those are $13. And if I go 10 below that, that's the 80s. So now I've moved to the 8100s instead of the 85 110s. My bottom is about the same. I've given up $5 in upside, and I'm spending maybe a little bit more money to do that. So where's my confidence level? Goes back to that now. So do I feel the need to be in the 8100s instead of the 85 110s? No, I think the 85 110s are going to work. I think that's a fair price. I got 2 years. And honestly, here's the other thing about it, though. I really don't need the whole thing to be in the money, but I think the 85 110s for 10 bucks is a good trade. So therefore, that becomes my trade. I want to take the 85 110 bull call spread for $10. I'm going to sell 5. So 10 of those. I would do 10 of those, right? Then I'm selling 5 of the 95 puts for $15. So 5 times 15 is, math, $7,500. So I get $7,500 here, and I spent, what do we say we're going to do, 10 of these? So 10 of these is $10,000. So I'm spending net $2,500 for a $25,000 spread. See how amazing this is, right? Doesn't it look great how this works? So I'm spending net $2,500 for a $25,000 spread that is currently $15,000 in the money. There you go. Boom. That's how I make a trade for you guys. And then I say, wow, that's a great trade. You can make 10 times on your money. And it's JP Morgan, and it's very safe. It's very easy to do. Not only that, though, but we have 10 longs, we have 5 shorts. It would not be a big deal at all for me to sell a couple of short calls. Like, let's see, 94. So I could sell the 110s, which are quite a bit higher, for $2.25. Let's say we sell 4 of those, 4,000 bucks. That means I've got 10. Don't forget, we have 22,500 in profit covering that on the upside. We have all the time in the world to roll these things, and we're going to make $1,000 for 86 days out of 576. Now I can't do that math. 56, 8 times 86, 8 times 7. So it's 7. So I have 7. I can roll. We can sell those 7 times and make $1,000 in premium 7 times while we're waiting. That would turn the $2,500 debit spread into a $5,000 credit spread if you manage to sell all 7 times successfully. But given that we're going to make 10 times our money, why take any risk at all at the moment? And why not wait for a spike to do some selling? So when it spikes up, we're going to do some selling and lock in the profit. But at the moment, leave it alone. It's fine. It's going to make 10 times your earnings. It's going to make, it's going to make 10 times return on the net cash. Why not do it? And that's it. You are all now qualified to do my job. All right. Let's see. Bernie says any company, blah, 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 blah. Okay. Oh, no other questions. Fantastic. All right. We're done. What else is going on? Let's take a look. How's the market doing? Oh, that's JP Morgan. So everybody's not having a good day, huh? YM. Oh, poor little market. I'm having a good day because I shorted ES. What else? Oil took a real hit. Who wanted to be bullish? One of you guys wanted to be bullish on oil, and I was like, I don't know about that. You can't just, it's, I know July 4th is usually a great trade, but I don't see it. It's just, we're too screwed up. You don't even know if in 2 weeks from now, it's not even a definite that things are going to be open. We are having a massive disaster in states like mine, Florida. Oh yeah, well, we haven't talked about that yet. I don't like talking about it's depressing, but okay. Anyway, wow. Yeah, I'm depressed. I'm already depressed. Okay. This was June 3rd. Okay. This was June 10th. Oh, well, it's not the same one. That's America, 2 million, not even 2 million. The world, 2 weeks ago, 7.2 million. And now, two weeks ago, 7.2 million. 9.2 million. 2 million more people have been infected in 2 weeks. 1 million people per week. 52 million people per year. But not on this curve. On this curve, it's 1 billion people in a year, easily. That kind of curve, when you've got this many people infected, it's going to go like this. This is 2 weeks. It's crazy. 1 million people a week. All right, am I too far? Wait, third to the, I'm sorry, 3 weeks. 3 weeks. Oh, much better. All right, 3 weeks. That's 9.3 million. And this is, no, oh, that's not the world. Damn it. Oh, that's where I got the 2 weeks from. I'm sorry, it is 2 weeks. So yeah, 7.2 to 9.3 is over 2 million people in 2 weeks. America, well, I mean, we'd say in the same 2 weeks. In the same 2 weeks, America, 1.9, less than 2 million. 2 weeks later, 2.4. Or 2.34, all right, it's 2.35, let's be fair. 150,000 people per week infected with a virus. 10% of those people are going to die at 150,000 a week. 15,000 people are going to die. They're not going to die now. It takes time to die. This thing has to run its course. But basically 10% of the people who are infected end up being dead. Of the people who are seriously infected, and that has not changed. You can talk about testing this and testing that and whatever. Bottom line is not changing. 121,000 deaths. That's so far. It's 5% of the total infected, but the problem is that the total infected and the newly infected, that's the thing that people don't understand. It's like the newly infected is not included in the deaths because they're currently ill. And the 5% of those people will die. And it ends up being 10% when it runs its course. Some countries have better controls than others. China actually kept theirs down to about 5%. They only had about 4,000 deaths with 84,000 people, and the virus has run its course in China basically. It's not nothing, but it's much. I mean, look, you can see it's much better. This total disaster. The worst disaster on the planet Earth is right here. So very upsetting. Only, I don't know how Mexico does it. How does Mexico only have 23,000 when we have a couple of million? I don't see how they can do that. I guess not. I guess not many people are really crossing those walls. Good job, Trump. That just seems crazy that they get so much less than us. So anyway, so it's not good. None of this is good. And then that's it. I'm done with this conversation because it's not fun. I was having fun, now I'm not having fun because I get upset. So let's talk about something else. Where were we? Which way Wednesday? Oh, that was last week. We were testing the 10% line. Well, what happened to the 10% line this week? La 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 la. Let's go to my dashboard. What is it called? Philip Davis. That's me. No. Show my credit card information. Charts and tools. What do they do? They changed it. You guys, dashboard. There it is. Your chart list. I think. There you go. Default list. So to make it so hard to find. Oh, yeah. Good luck. They see there's something wrong with this, and they really drives me nuts that people like so lackadaisical about their own site. This has always been broken. It always says today's date. And why would it say today's date when I haven't touched it in months and months and months? It's like it doesn't, it's like you say the last date I modified it. So one of these S&P charts, and I think I got smart enough to number that one, March 16th. So I guess, is March 16th the last time I did one of these? Nope, that's not the right one. Damn it. The 5% rule one? Must be, nope, son of a bitch. The February one? Oh, well, that looks like it. It's interesting. Okay. Either way, that's the right line. So it's 31.35. Okay, so it seems like messy, but maybe the other one was messy and I didn't notice. Anyhow. So here we are, once again rejected. This is, I guess, today's chart, today's candle. And why is it giving me, I'm like in edit mode. Maybe I'm always in edit mode. I don't know. Honestly, no idea. I don't know how this thing works at all. But apparently, you see what we're doing now, we're bouncing off the 200-day moving average. So of course the 200-day moving average is going to give you support. Look at the 50-day moving average. Look how good that support is. You got the rising 50 and you have the 200. And we're testing. So this should be bouncy. And if it's not bouncy, you got big problems. But we should be bouncy. We'll probably bounce along here a bit. But here's the problem. Once this guy stops going up and starts curving over a bit, then you're in big trouble. Then it's dragging you below that line. This whole thing's going to do down. So hope that doesn't happen, but it looks like it's trying to happen. It looks like we're trying really hard to bust down there. And that's despite, okay, here's where we start going down. Here's the first round of stimulus. Here's more and 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 more stimulus. And now it's not enough stimulus. And we're going down again. What's going to happen? Obviously, Mr. Trump needs to be reelected, and he thinks money fixes everything. I think you could agree that would be his personality type. Therefore, he will throw money at this problem. And the Fed will print money, and Trump will throw money, and Congress will approve money because they don't want to get voted out of office either. And the Senate is even going to go along with this stuff, which they never do, obviously. They don't like to spend the money. Well, when Barack Obama proposes something like universal health care, oh, no. But when all of us are dying because they didn't approve universal health care, oh, yeah, then they'll spend the money to save the businesses. Smart. So, GOP is approving, we did that last week, where's my national debt clock? I love it. I mean, come on, how can you not love the national debt clock? National, that's both right, yes. Okay. I realize it's not my spelling that's getting worse, it's my eyesight is getting worse. And so I end up thinking I spelled things wrong just because it doesn't look right when I look at it. And my typing sucks anyway, so that's beside the point. So here we are with our $26 trillion national debt. Speaking of things that are horrifying, I think 2 weeks ago, that was significantly lower. Like that'd be, I don't know where you have the thing of that. I don't know if they have a history of the national debt clock, but I mean, I am telling you, that thing goes up so fast now, I can't even deal with it. It's like incredible. I mean, you can see it going. These are, this is millions. That number is millions, and you can just watch it tick while you're watching. Like it's not even a sec. It's not even a minute hand. It is a 15-second, 20-second, 30-second something that this thing ticks up. 30. I would say 30 seconds. Looking at this, so figure every 30 seconds. So you're doing about $2 million every single minute of additional debt. And it is not stopping. And I'm telling you something, I think this number is wrong. I don't know where they're getting this number. In fact, what? Look, it's right. I'm right. It's going backwards. Look at that. It's counting backwards. So debt going up, revenue going down. This one too. This one's going down pretty fast too. Look at that. Down 2, 1, 0, 5, 9, 8, 7, 6. Uh-oh. Now, are you going to tell me that this going up this fast and this going down that fast is not going to somehow cause a problem? This is a business where I would be, if I was consulting on the business, I would be saying, you really should shut this down before you go bankrupt. You were better off closing your doors, defaulting on your mortgage, defaulting on your rent, and just packing it up and finding another line of work at this point, because this is probably not salvageable. I would be like, what is your actual, I'd be saying to the person, what is your actual plan to fix this? What are you doing to stop the bleeding of revenues? And what are you doing to stop the incredible incursion of debt that you are causing every single minute? It's going in opposite directions by $1 million. Like your costs are going up $1 million every minute, 2 million a minute, and your revenues are going down, not 2 million, but 100,000 a minute. So your revenue is going down 100,000 a minute, and your costs are going up 2 million a minute, and your revenues are nowhere near your costs. Look, this is your cost. So your cost is flying up, your revenues are going down. Are you going to change anything? These are my questions. If this was a company and I was consulting, this is my question. Are you planning on making any major changes? Do you have any way to control these costs? Well, we lowered our borrowing rate to 0%, basically. And I'm like, oh, that's good. How much is that going to save you? It's like, no, this is with the 0%. We're already at 0%. That's what it looks like at 0%. So it's like, it was much worse. I've had people say to me when I consult on businesses, I've had people tell me, well, it used to be worse. I'm like, I can't even believe you can afford to have me here in that case. How did you have the money to have me fly over here to talk to you? So anyway, so yes, if this was a business, I would be like, oh my God, I better get my check now. It's like, make sure they paid in advance. Um, so this thing is just completely flying out of control. And we're collecting less money. We're piling on the debt. We're pushing it off onto our citizens. Where is this? Oh, it's state debt. Sorry, that's only your state. Oh, there's your state debt also. We didn't pay attention to that. State debt's now well over $1 trillion. And that's going to get way worse very suddenly in June because all the states run their budget along a fiscal calendar, so they end in June, and they have to rejigger their taxes. So now, and they have to have balanced budgets, and so does your local county. So the problem is, what's going to happen is in June they all have to balance their budget. Now, in March, April, and May, there were no tax revenues. Same problem these guys are having, right? They have a big problem. All the tax revenues running backwards. So they are piling on. Look at the local debt, 2 trillion, state debt, 1 trillion. They are piling on the debt, and they're supposed to have a balanced budget. And so piling on the debt, less revenues coming in, and businesses that go bankrupt and close, they don't pay their property tax, no property tax revenue coming in. Remember how you live in a commercial zone or you live in a town that has a lot of industry and you go, oh, my taxes are so low, this is great. Well, what happens when that industry starts shutting down? So much for your low tax base, right? So much for the spreading the money to the corporations. All of a sudden, the towns, which must balance the budget, you guys are going to be freaking out in a couple of weeks. They must balance the budget, and the towns have only a couple of levers to pull. They can raise the sales tax, which is difficult. They can increase parking meter fines by 1 billion%. They can raise your property taxes, which is their go-to, and they can raise school taxes, which people freak out about. So generally, property taxes are going to get raised. That's pretty much going to happen a lot all over the place. And in the middle of a crisis, you're going to get a notice that your property taxes are going up significantly. And what does that do? When the property tax goes up, what is the government really doing to you, though? Here's where you get totally screwed. Because the government is going to raise your property taxes. So think about this now. If you're teetering on selling a home, when the government raises the property taxes, that's like raising the mortgage, right? So if your taxes were $6,000, just to make an easy number. Taxes were $6,000 a year, so they were $500 a month on your house. Your house mortgage, if it's a $500,000 house, let's say you're paying $2,500 a month in mortgage payments, right? So now you're paying. So the cost of running the house is $2,500 plus $500 in taxes is $3,000. So your house is worth $500,000. But what happens if the taxes go from $500 a month to $650 a month? And all of a sudden it's $150 more. Well, that means $150 is going to get cut out of your mortgage. But then that means that so the person who's buying your house is now going to say, well, it's 150 more. It's got to come off your mortgage then. And if it comes off your mortgage, it comes off the price of your house. And if it comes off the price of your house, you're going to lose $50,000 on the sale value of your house, something like that. You can lose 10% of the sales value of your house in the property tax increase. So think about that, because when those property taxes start going up, the money gets sucked out of the value of your home. And by the way, that's what killed everybody in the Northeast, because the property taxes went up and up and up like crazy for years, and our home values did not go anywhere because the property taxes are so high. And that happened in California too. I understand why people freaked out about Proposition 13 back in the day, and this is how Reagan came to power. Again, it's the same kind of issue. It's like taxes, because it's ridiculous. Because what happens is you have a home and you bought it, and yeah, the home is worth a lot more money, but the taxes are now double, triple what they were when you bought the home. So instead of getting the money back in your home, the poor guy who's buying it is just getting hit with this giant tax burden that you want. And that's why I live in Florida now, not New Jersey. No, it's like way, way different. Not to mention the lack of state taxes, very helpful. It's like a free house. It's amazing. Like I say, hey, I would say everybody should move to Florida, but then you'll die of the disease. But other than that, it's like it's amazing that you can actually, if you move to Florida between the lower Florida, this is why people do this. You say, why does everyone move to Florida? Well, you do the math from the Northeast. By the time you save your property taxes and your state taxes, your state income tax, it's free. It is free compared to living up there. I take all the money I save up there, and that's my housing cost down here. That's the difference. It's that drastic. All right, what do we got? Tiffany, do I still feel good about Tiffany acquisition? I don't know. I don't know what people are doing as far as, okay, first of all, sorry, let's take that back. Those aren't people. No offense to my rich friends and you wonderful people here, you're not the ones I'm talking about. But the people who are buying Tiffany diamonds are not, quote, people. They are the uber rich. And obviously not all of them. It's lovely to get a Tiffany. I've given plenty of Tiffany in my day, but it's rich people. It's not poor people. Okay, I mean, I know they have little tchotchkes at the Tiffany shop, and you can buy silver things and stuff like that for under $100. But in reality, no one's walking into Tiffany and buying a necklace or buying a thing because it's literally double the price. You're paying double the price that comes in a Tiffany box. And yes, everything in that store is really phenomenal quality. I have never, I bought, as I said, I bought many Tiffany things over the years. They're all still around. They're all still cherished. They're all still things people really like that I bought them once. And so worth it. Yeah, sure, it's worth it if you have that kind of money. But what in this environment is that like? I mean, I'm old, so I'm not getting engaged anymore. My mother has enough jewelry. I don't buy her stuff anymore. We're not like, we don't, it's a kind of stupid anniversary gift when you can get a car instead. So it's not really something that somebody in my age group would really be affected by. And I'm not so rich that I just routinely give Tiffany to my kids or anything like that. Although I did get them, what did I get them? American Express had some special this winter. It was like half price for Van Cleef and Arpels or something like that. So I bought my kids both something really nice. They're like half price. I was like, why wouldn't I do that? It's like cool. So it's both there. Like for both of them, it's like their best piece of jewelry. But anyway, normal people don't do that. And so the question is, if I'm of a dating age, or if I'm a younger person and I've got money and I've got nothing else to do, am I going to the Tiffany catalog? Because I'm not even going to the mall anymore. I'm not going to the store. I'm not walking down Fifth Avenue to go to Tiffany's. So am I going to get the satisfaction by going online and ordering Tiffany's? And I think maybe not. I think it's kind of a dangerous time to be looking at them because it seems like, is the acquisition going to happen? I think so, yeah, because the money's there. That's a different story. So I don't know if there's any kind of news on it. Oh, I'm not going to go into that now. But yes, I think the acquisition is still going to happen because there's still plenty of money in the world. Whether I think Tiffany is a good idea for the acquisition, that's a whole different story. But Candle Glass Gallery did right, Tiffany. But again, what are rich people going to spend their money on? They're going to spend it on something, and it's something still you could spend money on, still have fun. If it's, by the way, if it's Christmas time, that's different. You don't, people want the box, so you just, even though you're looking online, you see that you can get the same thing for half price. It's not the box. So that's and you can't fake it because then you're in big trouble. Believe me, I've seen that. So don't fake it. Don't try to do something else. Don't try to substitute something. And notice this is not a big variation, although that's kind of a scary looking thing. It really only went from 130 to 100. It's not a huge drop, and it came back super fast. Then it went from 128 to 110, came back super fast. This is probably the right range for Tiffany. It's not so bad. 120. We'll see what that looks like over here. I think they're probably trading a bit higher than I would probably want to be in them at the moment. We were in them for a while, weren't we? But we decided we didn't like them anymore. No, that's not good. What is that? 15 billion, and they're only making, even if they made 5, that's 30 times earnings. So big no to that. So yeah, the acquisition is going to probably go through, but I wouldn't buy them. I got no reason to buy them. You could sell a put and play that game. Let's see if there's any news on this thing. News. Nope. Oh, formally clear the OB. Oh, see, it's still going through process. Yeah. Yeah. See, I mean, they got money. See, you told me that, it's not like they don't have money. Just because we had a little crisis, or just because they're losing money this quarter, doesn't really matter. Are they experts expect to close in the middle of 2020? Ah, there you go. Merger in the middle of 2020. Actual length of Australian foreign. Okay, who cares about that? All right. So there you go. That pretty much answers that. They wouldn't be screwing around and doing all this stuff if it wasn't going to happen. So then the question is, that's why it's snapping back so fast. I mean, it's a merger on, merger off. And I guess people panic when they think the merger is not going to happen. They jump out. But I don't really see it. I think it is going to go off. It'll go off that price. There's no reason that Hennessy's going to, or Moët, or whatever, whichever their primary, they're not going to jump out of this thing at this point. So I don't think it's worth trading. Take a look. TIF. No, that's not bad. Damn. Would I do that? I mean, if I could get this is 9, 7, 750, I would do those. I would sell those puts if I can get that price, but I don't think you really can. Look at you beat your well, that's the opening. That's not the bid ask. This chart screwed up. It should be bid ask. All right. That's not going to tell me the right thing. Why is this side not? Oh, here we go. Bid ask. That is the bid. Why was I looking at? Oh, I was looking up there. That's what I was trying to figure out why that was wrong. All right. So bid ask. So we're talking about bid for 2, ask. So nobody's getting the ask. You can see that on the last. So probably selling the 95 for 750. I don't think that's a bad play. You're back, you're back in the mid-20s for like your price earnings ratio, and it's not a terrible company. I think it's good over time, and if they almost got acquired once, they might get acquired by somebody else if this one falls through. So a lot of good chances that you're going to make $7, and not too many bad outcomes. You're just stuck with be stuck with a few hundred shares of Tiffany. That's all. So I would do that. If you want to get some cash, I wouldn't mind doing that. But I'd save the 95, and I'd want to get the 750. I don't want to get, wait for a downbeat, or just offer to sell it for at least 7. Just if you get it, you get it. If you don't, you don't. But that's the best way to play that, I think. So how's this? I think 30.50 should be the stop on that one, right? All right. So anywho, see if you have any questions. My voice is getting a little scratchy, so I'm going to not keep going and save myself. Any company you think will be weak or strong? Oh no, we did that one already. Okay, good, fantastic. We are all caught up. I think things are going well. Protection wise, why don't we take a look at our portfolio and see, as long as now, what do we say? It was just around $1.4 million for the long-term and short-term portfolio this morning. Now the short-term portfolio has jumped up. Wait a minute, is that right? That's crazy. That's crazy, man. That's not it. That's not today's article. That's today's article. Love that picture. I like that he's got the hat crumpled in his hand. Why is he holding the hat? What is wrong with him? Why does he hold the hat like a blankie? Where are we? I know I did the math on this thing. Rest of the world. Ah, here we go. Yep. You see, it's like, I can't even believe this can be a number. 504 as of yesterday's close, and all we did is bump down a little bit, and we are at 545, $40,000 this morning, or today, whatever. But $40,000 since last night's close on the short-term portfolio. So what we know is that we are freaking bearish. This is a very bearish setup because we just made $40,000 on a teeny tiny tick down on this. It's 2.5%, not a huge move down. And we made $45,000. But that's great. That lets us know that we're being well protected. Now, how much did we lose is the question. So in the long-term portfolio, dun 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 dun, 67%. Whoa, that's painful. So the long-term portfolio is down to 834, and it was 892. So we lost 60,000 in the LTP, and we gained 40,000 in the STP. So we lost net $20,000 on a 2.5% drop in the market. So that means as long as now, also you have to understand about the hedges though, is that because of the way we hedge, you're not going to get an immediate payoff on your not the long-term portfolio. There's two factors. First of all, when the VIX goes up, there we go. So when the VIX goes up, it's bad for the long-term portfolio. So part of the reason we lost a long-term portfolio is the VIX jacked up. That's always bad for us and gives us, and it went up a lot from 25 to 35. So that's what, 40%? So the VIX jumped 40%. Oh, I'm sorry, that's June. That's not hourly. That would be a lot. All right. So only 10%. So it went up 10% since yesterday. So the VIX is up 10%. No big whoop that the long-term portfolio looks bad because we sell a lot of premium. Therefore, this premium we sold is jacked up in price. And as long as we don't do anything and wait for things to calm down, doesn't matter. Then we are talking about, yes, right. So that's the long-term portfolio. Now in the short-term portfolio, because of the nature of the short-term portfolio, because we have a lot of spreads, then the net of the spread takes a long time before it realizes a gain for us. Okay, like here, the Tesla, well, forget Tesla. On the SQQ, you're not going to really see the full amount. In fact, look what's happening now because the 500 calls are not showing any big gains. They're in fact showing a loss, but because they're in the money and they're not helping us. The $15 calls, though, they got jacked up and are, well, they're still showing a gain, but not as much of a gain as they were. So that's hurting us in the short-term portfolio. Still, though, the short-term portfolio is doing very well. The SDS winning on both ends. Here's the SDS short calls, right? Still doing very well. Here's sugarcane. What else is exciting on here? This SDS we talked about. Here's the TQQs coming into the money. Here's CMG making nice money. This one, you know you're going to win. You know, it's showing a $30,000 amount, but meanwhile you're $3 in the money. That's $60,000 in the money. So you're $60,000 in the money. It's only showing you $30,000 of it. That's what I mean. You go in the money, but you can't tell because of the spread. The spread screws up your numbers. So probably. So what did we say we were short? We were short $30,000. It's right here. We already can see where it's going to be made up. And then Tesla. We're in the right place. We have the short July calls that we sold for $72, and we're at 963. So these are actually even, but they're showing a loss. And we have the short 850 puts. Clearly, we're over that number, and we're showing a loss on those. So we're being shown a loss for things that we're in the money on. So what I mean then is there's a lot more money in that portfolio than it looks like, and that's why you got to remember not to be lazy. And you have to analyze why your portfolio says what it says, because a lot of times, and I don't want to say your broker's wrong, because if you had to cash out right now, that's your balance, because you're going to be forced to cash out at those prices. But if you're not forced to cash out, then you can ignore it. The same way if there's a housing crash, you know, like for example in 2008. Okay, so in 2008. The price of my house went from $1 million in Jersey to $450,000. I would say probably during that crash. Probably lost 50% of the value of my house. Doesn't matter. I had no intention of selling it. My kids are in school. We had a great neighborhood. I like where I lived. It was great. The taxes weren't crazy yet. So it made no effect. And then when I went to sell it, I sold it for the regular price. It was fine. Because if you're not going to sell something, who cares what the price is? I'm still using it. I don't need to sell it. It's still in my portfolio. I'm still an IBM person. I'm still this person. I still like my stocks. You don't have to panic. So, you know, that's very important part of investing, is learning not to react to stuff, because, and it's just like your house. And the funny thing is, people understand that about their house. It's like, I live here. I pay this money to live here, and it's the same. And it doesn't matter whether the price of the house is $1 million or $500,000. I'm still going to pay to live in this neighborhood. I still like this house, and it's where I want it to be. It's what I want it to be. So I just keep paying it. Same thing in a portfolio. Keep your investment in there, let it come back to normal, then decide what you want to move around. And the great thing about hedging, the way we're hedging, is because even when it changes drastically, I don't care, some winners, look, some winners and some losers in the long-term portfolio, some winners and some losers, they balance out. And that means that no matter what the crisis is, I can just start cashing things out selectively, move money from one place to another, right? I remember last week, in fact, that's not even reflected here because we didn't do the changes in the LTP yet. But last week we lightened up on the LTP because we got more bearish. I called a bunch of positions off. We got a little more aggressive on the STP, a little less aggressive on the LTP. And what does that do? If we have less aggressive on the LTP, then the same on the STP makes it stronger and more hedging, because I have less to hedge against. And that's what you do. And it's so much easier to balance your portfolio that way. It's so much easier to keep a steady thing. And I'm so excited about teaching my daughter all this stuff. It's gonna be fun. It's like, I never wanted to push them. Jackie is the one that actually has like a really good natural talent for understanding stocks and stuff, but she's got no interest at all. Maddie has actually started to show an interest. So she was zero interest before she left for college, but now she's actually like starting to contemplate like her future and stuff. And she's like, I better put some money away. So I'm like really pleased about that. It's good. But anyway, so I'm excited to like teach her how this stuff works. It's really fun. I enjoy doing it. Anyway, so that's it. So as the story goes, if you're balanced, you can make great choices in investing. You can take advantage of great opportunities. When you say, oh, I really want to buy that stock, you can just look at your stocks that are overperforming that you want to get rid of, or you take some cash off the table. It's very simple. And you get better and better at balancing. It's just like anything you try to balance. You just get better because you learn these little tiny adjustments make all the difference in the world. Like I have an electric bike, and I hadn't ridden a bike in a while, but I love my bike. I ride it all over the place now. And you know, the thing that you have to remember, the real light bulb for me when I started riding it was, I was like, you know what? Momentum fixes everything. The dumbest thing you can do on that bike, it's a very heavy bike. Because I'm no lightweight either. So I mean, you know, I bought a big heavy electric bike, and so when you're going forward and it's moving, the bike is as stable as anything. You know, same with motorcycles, right? When you ride a motorcycle, as long as it's moving, everything's great. But when it stops, it's a big, heavy, wobbly thing. So when you stop, just like a motorcycle, you got to put your foot down. You got to make sure you're bracing something and you're holding it up, and but when it's going, so in other words, the dumbest thing you can do if you're trying to swerve around something is to try to put your brakes on and swerve, because now you screwed everything up. Then you lost your momentum and you're no longer balanced, and then any little thing can throw you to the ground. So you learn to like almost accelerate into like a problem. So if something's going wrong in front of you and you're going to have to turn around it quickly, you just accelerate into it, and it gives you better stability to make the turn, which is a little counterintuitive. Trading's like that too. If your portfolio is well balanced, when you hit a rough market, you have that better stability and you can take advantage of it. You learn to say, oh, now instead of stepping on the brakes and crashing, I'm going to like put on the gas and avoid the problem entirely, which is what we did back when the market crashed in March. We put on the gas, we deployed more of our cash, and we put it in. Now, last week, we started pulling the cash back off the table because I might need it for later. We're on a smooth, straight glide path. Everything's going perfectly well. The market's been hanging out around this top level here. And I'm saying, okay, I don't like this. I don't like the spread of the virus. I don't like that they've run out of stimulus money already. They spent it all. They might have more stimulus, but what if they don't? What if they do what what if they do what Congress always does, which is stop, get into a fight, start threatening each other, and leave everybody hanging? What if that happens for the 50th time? Let's worry more about that and less about what we do if we go to Dow 30,000. That is my final statement for the day. So thanks everybody for coming, and we will do it again next week. All right, take care, guys.